All right, so we're going to talk about trading the VIX and the VIX ETPs. Before we get going, the standard disclosures. I'd like to remind everybody that if you lose money, it's your own dumb fault. That's really what this says, and you know, good things for you guys to remember. So for those of you who aren't aware of who I am, my name is Mark Sebastian. I'm the founder of optionpit.com and the chief investment officer at Carmine Capital. We run 2 hedge funds, and one is a volatility-based hedge fund, one is a smart S&P fund. I was a floor trader, just like Andrew. Actually, I was around the corner from Andrew on the SIBO. And before I was on the SIBO, I was on the American Stock Exchange in New York. After I left there, I founded Option Pit. We're an education and consulting firm. I work with retail traders, teaching them how professionals think and trade, and I work with professionals, helping them implement option strategies. You would be surprised how many professional investors don't really understand how options work and affect things. Why are they called ETPs? And because there are 2 types of VIX products. There are ETFs, which is an exchange-traded fund, and ETNs, which is an exchange-traded note. And so to encapsulate both ETFs and ETNs, we use the term ETP, which stands for Exchange Traded Product. Does that make sense? All right. So here's what we're going to talk about today. What is fear? What is volatility? What is the VIX and the VIX futures? How VIX works and how VIX ETPs work. Should be fun. Fear. What is fear? What is fear? I mean, fear is basically being afraid, being unsure. It can be anxious. It can be terror. It covers a lot of pieces, right? There's I'm afraid I might become afraid, and then there's I am terrified. So like in the case of my 8-year-old, right now my 8-year-old has fear. He's afraid of the dark, and more importantly, getting in trouble with his mom. And to be fair, so is his dad. His dad is terrified of getting in trouble with my son's mom. And if yeah, she just said neither of us are afraid enough. Well, if you've seen her angry, you'd be afraid too. So, you know, we all understand fear at the interpersonal level, but for those of you who don't know, that is her looking at me, looking at the camera, not so pleased with me at the time. So, but what is fear to the market? That's what I think really matters. And to me, this is fear. What we're looking at right here, this is terror. This is the market is unafraid. It's afraid of everything, right? Here's the market is anxious. Let me erase this a little bit. And I'll take you through. Here's the market is anxious. Here is the market terrified. All right. This price action is fear. Indeed, TJ. That's terror. And we just saw terror. So to me and to the market, I want you to think about fear as volatility. All right. Fear and volatility are interchangeable in a lot of ways, right? You can have fear on a rally. You can have fear on a sell-off. In January, who remembers that wicked rally we had in January? How many of you remember that wicked rally we had? Yeah, we all remember that wicked rally. I mean, it was nasty. Let me go back here. This was nasty. Now, did anybody, I know I did, I mean, people experienced fear during that rally. Why? Well, we're afraid it was going to end. We're afraid it's too far, too fast, right? That's like a fear that's like anxiety. Then you have, so this is kind of anxious fear, anxious volatility. It was volatility on a rally. And then here is straight up terror, and that is volatility on crazy movement. So volatility is a measure of movement of an underlying instrument over a specific period of time, regardless of direction. Volatility can happen on the up, it can happen on the down. Tends to be bigger on the down than the up, but the up tends to have a lot more momentum, right? You don't tend to see, you tend to see up day after up day after up day after up day, where 3 days in a row of 20-point rallies can quickly is 60 points. It's crazy, crazy move in one direction. And then you have the downside where it's 60 points in a day. All right, so that's the thing. So the higher the volatility, the higher the movement and or expected movement of the underlying, the more fear there is. So when we're running, when we're gunning, when the market is really illogical, that is fear. All right. Fear in the market is kind of the absence of logic. Does that make sense? So like you look at the market, you go, why the heck? How in the world are we down 100 points today? It makes no sense. Fear. Why do we keep rallying? Fear. If I don't buy, it's going to go down. If I don't buy, I'm going to miss it. Right? FOMO. You guys know what FOMO is? Correct. Alex down the hall knows. It's the fear of missing out. FOMO's a thing. And that's what ran January up. So now, let's talk about fear in the market in a more concrete way. What makes trading volatility different than trading a stock? And the answer is, over the long term, we know where implied volatility of a stock or index is going to go. We don't know where the stock price is going to go. There is a mean reverting characteristic to fear. Fear has an equilibrium. Stock prices don't. Housing prices don't. Right? There is an appropriate level of fear. Right? Right? I have an 18-month-old. All right. On a daily basis, do I have fear? On a daily basis, do I have fear? Yes. All right, but is there an appropriate amount of fear for a 1-year-old or an 18-month-old? Yes. Right? Should I be afraid that should I check the floor to make sure there's nothing that he's going to eat and choke on? Yes. Right? But every time the kid moves to, takes a step, should I be afraid he's gonna fall down? No. Right? There's an appropriate amount of fear. That's that equilibrium. My wife might argue I don't have enough fear. She might argue I have too much. So that is, fear in everything has an equilibrium, and so does volatility. Volatility is mean reverting. So here is Apple stock. This is from kind of October, November. So you tell me, you look at that. Does that, your Elliott wave people say, well, there was a wave here that, waved up and down that brought back. So, I will submit to the Elliott wave people and the technical people that there are maybe very near-term equilibriums for a stock. But in the long run, I'm talking 1 year, 2 year, 3 years, do stocks have a mean price? They do not. Right? Now, I'm going to pull, so this is Apple. Now, I'm going to pull up a chart of VXAPL. And you guys probably have not heard of VXAPL, but what it is the VIX for Apple options. So this is the amount of fear priced into Apple options. Now, this gray line right here is the 200-day moving average. Folks, take a look at that 200-day moving average. You tell me what slope is that 200-day moving average? Does it look like it moves around a lot? All right. Does that appear to be moving around very much? What is the slope of this gray line? The answer is it's flat, right? It's very flat. And that's the mean reverting characteristics of volatility, is that we all have an assumption that volatility is going to revert back. It's flat. Right, there is a mean reverting characteristic. And that is what holds the 200-day moving average flat. So the key is, remember, a stock price can go anywhere and stay there, and volatility can go anywhere, right? It can go anywhere, but it won't stay there. It has to get back to its fear equilibrium. It must revert to its mean. And understanding that will help you with your buying and selling decisions for options. So, most traders think mean reversion is an instantaneous thing. But vols can stay low or high for very long periods of time. There are periods of time where vol can be extremely low. Take the period of time between really July of 2016 all the way to really the beginning of this year. Right? The VIX set the record for the amount of prints below 10 in a single year by about 6-fold, maybe 8-fold, something like that. There were about 53 instances. I believe there had been 12 total prior. All right, but it can also rocket sky high. Take a look at what happened in August of 2015. In October, November of 2016. Take a look at what's happening now. Right, we got the VIX almost up to 50 in the last week. There is the ability for vol to move quickly out of where it's been and pop. So anybody here know what a recency bias is? Recency, this should have a T in there, folks. Imagine there's a T. No, that's not where the T goes. A recency bias. Anybody know what that is? Yeah, it's the belief that what's happened recently is going to keep happening. And guess what? That's not the way life works. That's definitely not the way the markets work. They will be very afraid for a very long time, and then like that, it'll unwind. All right, so the VIX. This VIX is the CBOE or SIBO Volatility Index. Purpose of the index is to gauge the buying and selling of options in the SPOOs, the S&P 500. All right. It gauges the cost of insurance, and the idea is that when there is more buying over selling, generally the market is trying to buy protection. And when there is more selling than buying, the market is not out seeking protection. All right, so VIX up, cost of insurance is up, fear up. VIX down, cost of insurance down, fear down. The VIX, sometimes called the fear gauge, but it's more the volatility gauge, gauges how expensive it is to hedge. It's how terrified are people of getting into an accident, right? What is the terror level for the market? That is what VIX is telling you. How desperate are people to hedge? So similar to the S&P 500 index, the VIX is not actually traded, right? You guys know that. You can't go out and say, buy me the SPX. It's an index. You can buy futures, you can buy SPY, you can buy a basket, right? They all highly correlate to the S&P. However, you can't even do that in VIX. There's no basket. There's no nothing. The closest thing to the VIX index itself is probably a variance swap, which trades over the counter and in blocks of 1 million Vega. And if you're saying, I don't know what a block of 1 million Vega is, let me just be clear. That is a ton of money. All right. So to put it just in these terms, if I bought 1 million Vega and VIX and volatility went up 2 points, I would make $4 million on a 2-point VIX move. So it's for size. So the closest thing we have, I'm going to talk about, that is publicly listed, but we don't have a VIX that we can trade. So what it really is an estimate of implied volatility on the S&P 500 options that has a constant duration of 30 days. That means it always has, it's always mimicking a portfolio with 30 days to expire. And that's part of the problem is it'd be constantly rolling in and out of its spread. So that constant duration means it attempts to mimic that portfolio. So that means today the VIX has 30 days to expire. Guess how many days to expire the VIX has tomorrow? 30. And on Friday, 30. It always has 30 days to expire. It's quoted as a price, but it's really a percent. So right now the VIX is 20.04. That means that we're expecting 20% movement on an annualized basis over the next month, over the next 30 days. Volatility, despite not being spoken as percent, is always a percent. So the VIX is a percent of movement. That's all it's measuring. How much are we expecting the S&P to move in percentage terms? Not that difficult, right? All right, so 10% VIX, 10 VIX is 10% annualized volatility. 20 VIX, 20% annualized volatility over the next 30 days. We all get what annualized is, right? So if I make $500 this month, my annualized income is $6,000. I better make more than $500 though. So here's the VIX over the last 2 years. And this is what I mean by recency bias. Look, super low, huge pop, small pop, small pop. If you had a heavy recency bias, here's what you did wrong. Here's what you did wrong if you had a heavy recency bias. You assumed this move was going to be like this move and this move. When in fact, what we're looking at is a lot more like August of 2015. I think vol could be high for a little bit. All right, so VIX negatively correlates with the S&P. Generally speaking, when the S&P 500 is up, VIX is down. When S&P is down, VIX is up. It makes sense because guess what? They used to say we take the stairs up and the elevator down in the market. As of late, it's been more like we take the escalator up and the elevator down. But you do get a lot more movement on sell-offs. All right. There's also the nature of similar movement against a lower number. So for instance, we've moved $3 right now. If the S&P was 1,000 like it was 5 years ago, this would be a 0.3% move. Since we're at 2,700, it's an 0.11%. There is some of that. All right, so now let's talk about the VIX futures. They're the most successful domestic futures product listed in the last 20 years, probably. There's some bigger things overseas, but this is about the biggest here. Been trading about 100,000 contracts a day. It doesn't mess around. So like seriously, here's the VIX futures today. And it's traded, it's 12:30 it's 12:25 my time. And we've already traded 75,000 futures. That's more than corn, hogs, about as much as oil. Like, it does some serious paper. It's a real future now. All right. And they're typically used as portfolio hedges. They're in now, and this is key. The futures trade independently of one another. I pulled up all of these, and I want you to pay close attention. Where's that futures? Pull that back up. Second here, folks. I want you to see something here. So take a look. Take a look at the pricing here. The Feb that expires tomorrow is up 40 cents. March is up 80 cents. April's up 45. May is up 30. They're correlated, but they are not tied together. So they move in a related fashion, but independently. Whereas, like the S&P, they are straight up tied at the hip for movement. Right? The only difference between a March future right now and a June future, which are the two front month futures, is cost of carry in the S&P. That's it. All right, so now this, I want you guys to pay close attention to what I'm about to cover here. This is really important. This is called a Contango. And that means that the cash index, at this time it was 985, is priced below the front month future, which is priced below the next month, below the next month, below the next month. All right. And what this tells me is the market is at a relatively low fear or a fear of equilibrium. It's at an appropriate amount of fear. All right. It says the market is now, and it can get overdone. You might have made an argument that this is overdone. You know, too docile. You know, but this to me tells me the market is not afraid. Right? It's my son is in bed, but we left the hall light on and the bathroom light on, so he can kind of see, and he has no problem going to sleep. Right? Or I came home and I had flowers for the wife, and so even though I left the dishes in the sink, she's not really unhappy with me. That's what a contango really means. Then you have VIX futures backwardation. This is fear. What you are looking at is from this morning. This is fear. The index is above March, which is above April, which is above May, which is above June. This is backwardation. That tells me the market is afraid, right? I can tell my son there's nothing to be afraid of in the room. There's no monsters. There's no reason to be afraid of the dark as much as I want, right? How many of you got kids? Been through the same thing, I'm sure. I can tell him as many times as I want that there's nothing to be afraid of. Guess what? He's still afraid of the dark. I can tell the market, hey, this is stupid. Fundamentals are great. There's blah, 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 blah. There's no reason to sell off 100 points. The market is afraid. My logic doesn't matter. And I'll get back to this. But this is key. Logical, illogical. Not afraid, fear. So, when the market is not afraid, what does that mean for trading? How many of you have trading plans or trading rules or follow technical analysis or things like that? Right? I know I do. Guess what? When we're in this market, those tend to work. Now, what about when we're in this market? When we're afraid, what does that mean for trading? It means your well-regimented plans, your technical analysis are far less reliable. They're far less likely to work. If you take one takeaway from this, it's when we are backward, plan for your plan not to work. All right, VIX options, also really successful. All right, each month trades independently, just like the futures. Now, this is the one key on this slide. The underlying for VIX options is the future, not the cash. So if you want to know how to price a VIX option, price a VIX future. That is how that works. And they're hedges. This is from today. We've already, at the time, we'd already traded 500,000 contracts. That's more than the open interest of most stocks. Average daily volume about 1 million. VIX options trade. So does VXX options. So do you name it. All right, any questions on VIX, VXX, yada, yada, yada. I want to get to VXX. So any questions on kind of thinking about fear, thinking about planning, using VIX as a gauge to know how to plan the market, right? With the way we are structured right now, how well are your well-laid plans going to work? They're not. Not well. All right. All right, so now, King Sisyphus. Who knows who King Sisyphus was? Lauren, you studied Greek mythology. Who's King Sisyphus? So King Sisyphus was made to endlessly roll a huge boulder up a steep hill. The maddening nature of the punishment was reserved for King Sisyphus due to his hubristic belief that his cleverness surpassed that of Zeus himself. Zeus, accordingly, displayed his own cleverness by enchanting the boulder into rolling away from Sisyphus before he reached the top, which ended up consigning Sisyphus to an eternity of useless efforts and unending frustration. Thus it came to pass that pointless or interminable activities are sometimes described as Sisyphean. So, for instance, keeping my kitchen clean is a Sisyphean task. For my wife. All right. Yeah. So how does this relate to the volatility ends? They're very busy. They trade a ton. Well, let's talk about VXX, which is the iPass short-term VIX Futures ETN. And it attempts to be a future with a constant duration of 30 days. Intent of the ETN, the note, is to allow traders to get long or short near-dated forward volatility. The fund does this by constantly rolling out of futures and into the second month. Yeah, I know. Oh, sorry. And closing the door. Sorry, you know, it's the Italian in me, Dave, you know? So this is what I would call Sisyphean. You buy June for 1610 and slowly sell a little bit of it every day down to 1550. And then guess what you do? You go back and buy it for 1610. VXX is rolling the boulder up the hill and it falls right back down every day. And what you get is, if you bought a share of VXX split adjusted, what is a share of VXX worth today relative to it listing, right? So VXX right now, let me pull up a quote here. VXX is 43.69. So split adjusted, what is the value? What is the listing value of VXX? Nobody cheat. Someone said a nickel. No, that's split adjusted. What is its initial value? And the answer is $102,512. So split adjusted, VXX has lost 99.5% of its value. 99.995. Pretty bad. VXX is rolling itself to zero and should not be held for more than a few hours if futures are in Contango. Now, if we're in backwardation, that's a different story, right? Right now, in what is generally pretty rare, VXX is buying a future for 1765 and selling it for 1811. It's actually banking dollars, has a positive roll. But in the long term, this is what VXX looks like. Nothing good. So now let's talk about different products with similar results. You have the VXZ, which is the kind of long 4 to 7 months. That has not had a reverse split, but it definitely has lost money over time. Then you have VXY, which is the double long, levered, and optionable. And then you have TVIX, which is also levered, and then XVZ, which is the best of the bunch, but really doesn't trade. Now, I'll come back to this. Then you have the inverse ETNs. The inverse ETNs, all right, and some of these are gone now, and I'm going to talk about. You have XIV, which was the reverse of VXX. It's now gone. You have ZIV, which is the inverse of VXZ, and then you have SVXY, which is XIV but optional. It's a fun. And what I want you to see, this is what everybody thought was the smartest play. I can't lose. I'm long XIV. It's going up forever, right? VIX is 10. How do I lose? XIV keeps going higher. Well, here's how you lose. When these inverse ETNs they're not allowed to lose more than 100% in a day. Why? Well, it's an inverse. So if VXX goes up 100% in a day, how much would XIV or SVXY lose in a day? The answer is 100%. All right. Then, what if VXX goes up 120%? What would the net asset value of XIV or SVXY be if VXX went up 120%? You would actually have a negative net asset value. Think about that, a negative net asset value. You would owe the fund money. So because of that, they have protections in place to make sure that doesn't happen. And we had one of those trip. And it put XIV out of business and almost blew up SVXY as well. Now, what's interesting is, and I'll talk about this, is that everybody's terrified of these, and now is finally a time where they actually look like a value. And I'm going to spend a couple minutes looking at trades here, or answering a couple questions about trades, but I want to kind of show you my offer. So VIX contracts have unique characteristics. Each has their own underlying. IV and VXX are correlated, and VIX are correlated. Bear and bull plays have different structures. VXX and those ETNs are going to zero. Inverse ETNs can too, although they perform better over time. So now let me talk to you about what my offer is. And this is a deal. So I want you to go. So we have a course. It's a 5-part course. Each class, and this is already recorded, each class is 70 to 90 minutes. And it's our VIX Made Easy class. Over 5 courses, we're going to explain in detail how VIX works, how to make money trading it, how to manage positions, how to not lose your shirt, how to take advantage of all the problems with the structure and all the advantages of the structure. All right. We're also going to look at how to use it with SPX and SPY. You will get valuable and actionable education that you can use today, including how to structure trades. You're going to get email and phone support from us on all the questions that you get. In addition, I am going to give you our Vol newsletter. Our Vol newsletter will let you follow. We're going to put out 1 to 2 actionable trade ideas a week. We're going to give you 1 to 2 actual trade ideas a week plus a live class. All right, a live class once a week. And we manage the trade ideas from start to finish. They're all hedged. 4 out of the last 5 have been pretty nice winners. All right, and then finally, I don't know why it says, this part is wrong. Finally, I'm going to give you 1 month of Option Pit Live, which is also $97 or 125 depending. And that'll be just $97. But if you sign up today and you use code CANDLE70, so you have to do it today, I'll take an extra $70 off, so $27. Now, the vol new at the end of the month, you're gonna have an option. You can keep OP Live for $97. You can keep the vol newsletter for $97, or you can have both for $125 at the end of the month. Or you can cancel and say, hey, you know what? I like both of these, no interest. So $27 and you get all this. Go to optionpit.com/Orlando. Why? Because I love Tony Orlando. He's a good singer. I also like Orlando Cepeda. He's a good baseball player. And I like the city of Orlando. It's got lots of good amusement parks. So the $97 will be there tomorrow. The extra $70 off will not. So get yourself signed up. Now, I will take questions. And you can email info@optionpit.com or mark@optionpit.com to sign up. We did have one question. Can I explain the relationship between VIX 3-month, VVIX, and VIX? So VIX 3M is a 90-day VIX. So it looks at S&P options with 92 days to expire. VVIX is the VIX of VIX. So it's the volatility of options on VIX. And then VIX itself. So VVIX is typically a leading indicator of VIX. So when it's down, VIX tends to follow. And then VIX and VIX 3M can be a pretty decent leading indicator of the market. When VIX is above VIX 3M, market returns tend to be underperform. And when VIX is below VIX 3M, markets tend to outperform. That is my question. That is your answer. All right, any questions? And then I think that's my time, 44 minutes out of 45. I want to thank everybody for your time, and I will talk to you guys soon. Am I coming back to Silicon Valley in April? Either me or Andrew will, yes. Probably Andrew.